number one thing Wall Street keeps telling you is oil. But the economists who actually move money quietly, they're losing sleep over something else entirely. Chicago Fed President Austin Goolsbee said it himself, rising unemployment on top of an oil price shock creates exactly the kind of stagflationary environment that is as uncomfortable as any that faces a central bank. That quote came straight from the Wall Street Journal. And when a Fed official uses that word stagflation, you stop and you listen. Axios here is what actually happened. In late February 2026, military conflict involving Iran led to the near closure of the Strait of Hormuz. Daily tanker transits dropped from 24 down to just 4. That single choke point carries roughly 20% of the world's oil and liquefied natural gas supply gone, almost overnight. Oil crossed $88, then $91, then touched $110 at points. Yes, that part you heard about. Financial content, but here is what you did not hear. On March 6th, the U.S. Labor Department reported that non-farm payrolls dropped by 92,000 in February, the sharpest decline since post-pandemic stabilization. Unemployment climbed to 4.4%. That happened the same week oil was surging. Two disasters, one moment. And that combination has a name. Financial content stagflation. A rare condition where inflation and unemployment both run high at the same time. And according to Stanford's Institute for Economic Policy Research, once it starts, it is hard to reverse. Because if the Fed raises rates aggressively to fight inflation, it drives up unemployment and kills growth. But if it lowers rates to protect jobs and stimulate the economy, it risks driving prices even higher. There is no clean move. That is the trap. And Wall Street knows it. Stanford Institute for Economic Policy Research by late March 2026, traders in the futures market pushed the probability of a Fed rate hike, not a cut, a hike to 52%. That was the first time it had crossed the 50% threshold, according to the CME Group FedWatch tool. Think about what that means. The entire market spent months pricing in rate cuts. The entire narrative was relief is coming, and then within weeks, that flipped completely. CNBC here is why that flip is so dangerous in 2026 specifically. U.S. federal debt held by the public now stands at approximately 100% of GDP. When Paul Volcker raised rates to nearly 20% to break the inflation spiral back in the early 1980s, that debt was only around 25% of GDP. Corporate debt levels and household debt service costs are similarly elevated today. The government does not have the room it once had. The Fed does not have the room it once had. The tools exist, but using them costs far more now than they ever did before. Crestwood Advisors. And there is a third layer that almost nobody is covering. Johns Hopkins economist Steve Hanke argues that it is growth in the money supply, not just oil price shocks, that determines the overall course of inflation. His point is that if oil gets more expensive, people have less to spend on everything else. Supply chain disruptions change relative prices, but the deeper inflation driver is monetary. In other words, the problem is not only coming from the Middle East. Part of it was already built in. Fortune and the manufacturing data confirms pressure is building. The ISM Manufacturing Prices Index reached 84.6 in April 2026, its highest level since April 2022, driven by tariff and energy cost pressures combined. That number matters because it is a leading indicator. It tells you what prices are doing in the pipeline before they hit the consumer. Those prices are coming. Crestwood Advisors Bloomberg macro strategist Skylar Montgomery Koning wrote in a note that disruption to the Strait of Hormuz creates a far larger potential supply shock that extends well beyond oil. Energy touches everything: manufacturing costs, shipping costs, food production, logistics. When energy gets expensive and stays expensive, Every single thing you buy reflects that eventually. Axios. So, what does this mean for you practically? Motley Fool's analysts put it plainly: if you are concentrated in high-valuation growth stocks with little room for error, consider rebalancing toward companies with strong balance sheets and real earnings that won't disappear if the economy hits a sustained rough patch. Diversification is not just about sectors anymore. It is about resilience. The Motley Fool and the broader mindset right now, according to market analysts, should not be blind optimism or blind panic. It should be vigilance, monitoring the indicators, respecting the downside, maintaining some liquidity, and hedging prudently if needed. Naga oil is the headline. Stagflation is the real story. The Fed is stuck. The debt is high, and the manufacturing pipeline is already heating up. This channel exists so you see what the headlines skip. Every claim in this video came from a named, real source: CNBC, Stanford, Bloomberg, Fortune, Motley Fool, Crestwood Advisors, and the Wall Street Journal. Check them yourself. That is how this channel works. If that matters to you, subscribe, because in a world full of noise, the least anyone can do is tell you the truth.